I'm Max Keiser. Welcome to On the Edge. I'm here with Doss. He's such a famous economist, he goes by only one name, like Madonna. Doss, welcome to On the Edge.
I think Madonna's better looking.
Some would argue that point. But what is inarguable at this point is that the world is in economic chaos, that we had a big credit crunch in 2008, and it's obvious that we're now maybe resuming this credit crunch from 2008, or is it a new credit crunch? Fill us in on that a little bit.
I think it's resuming it, because in 2008 we never really resolved any of the issues, because what happened is, if you look at 2008, it was a warning sign that the world had too much debt, had to be reduced. So instead of actually going about reducing the debt, we just replaced one borrower with another. So the private sector started to reduce debt, the governments took up the slack. And we now have four really major warning signs. Number one, the first one is the economics of sovereigns. Now, Greece is 2/5 of nothing, really. The real issue is it's a canary in the coal mine. It's pointing to the fact that where Greece goes, so will potentially Portugal, Ireland, Spain, Italy, and France won't be far behind. But underlying all of this is a fantastic sort of question mark over the world. Can we sustain the levels of growth that we've become accustomed to? And the second issue, which is related, but not completely related, is we believe that our economic masters had all these powers. They had little levers, they pulled these levers. They were like the spaceship Enterprise, they could sort of control things, they could put a time warp on it. The problem is we've discovered that they have very limited tools. Indeed, I would argue they have very limited understanding. And now the question is, all the people in financial markets are looking at them going, these guys are like emperors with no clothes. Or as I like to say, it's like the wizard at the end of The Wizard of Oz. Because when you take the curtain back, you don't actually see a wizard. You see an old man running around with a pair of levers trying to keep up this illusion. And I think that is the fundamental issue, is the illusion has gone.
Okay, this is On the Edge. I'm Max Keiser. We're talking with Satyajit Das. He's the author of Extreme Money. The book is just out now, correct?
Yeah.
It's just out now. I got an advance copy, so I've been looking through it. It's really a fantastic book because this word extreme is a word that's not used in describing financial markets, but it should be used because these policies are extremist in a lot of ways. And, of course, this conjures up image of extremism and other types of factors that are guiding the economy. But on Wall Street and around the world, you really do see financial extremism. Now, I was reading a comment from David Cameron today, Prime Minister of the UK. He suggested that, well, the way for the UK's economy to be stimulated is that people should pay down their credit card debt. He very quickly got taken to the woodshed. The next day reversed himself and said, no, we want people to add to their credit debt because to do so would slow the economy down. What's going on there, Das?
Look, I think fundamentally the world has used debt as an accelerant. The best way to think about it is like the steroid of growth. And one startling statistic is that between 2000 and 2006, if you look at the United States, it grew by roughly between 3 and 4% per annum. But you can do some math, and you can basically strip out the effect of debt. If you stripped out the effect of debt, the growth was only 0 to 1. And so David Cameron's position is not surprising. The UK was the beneficiary of this debt-driven growth, and now he's got two problems. One, he's trying to rein in his budget deficit, trying to bring his debt under control, but he's trying to do it by the familiar measure of austerity, and it's not working because as the economy shrinks, his tax revenues come down, his spending doesn't come down at the same rate, he's caught. At the same time, he knows, we all know how we get out of this. It's growth and inflation. That's the only two ways you get out of a debt problem. And the problem is he's got no growth. So his comments about reducing debt, somebody pointed out to him, I think, you reduce debt, you reduce growth. So plan B, I think we'll put more money on the credit card. But I don't think it's going to work. People aren't going to borrow because they can't afford it. And frankly, banks aren't lending.
Okay, so clearly there's a huge disconnect between policymakers and the market as it exists in reality. They don't really seem to understand how these markets work, and even on the fundamental level. And then, of course, you are bringing up a point here about austerity measures that there is a notion in the UK to impose austerity measures, to pay off debt, to remove that drag, but now they're finding themselves in a position where they can't pay off the debt because this is what has been used to stimulate growth for decades. And the approach in the U.S., for example, is the approach of expanding the debt load through quantitative easing, through other policies. But that, of course, doesn't seem to be working either. So it opens up this picture here. Austerity, or debt-fueled, or let's call it Keynesianism, to give it kind of the word of the day. The third option would be bank reform. The fourth option would be embrace some kind of radical new school of economics. So am I correct in kind of describing the four corners of this?
Well, I think essentially the model is broken. What we're now seeing is most of our theories have huge disconnects in them. Bits don't work, bits don't connect. So I think you're right. People have sort of played around the field, if you like. And the real issue is, there's a wonderful phrase by Anton Gramsci, the Italian philosopher. He once said, "The old is dying, the new cannot yet be born. In the interregnum, all manner of morbid symptoms appear." To some extent, all this experimentation are the morbid symptoms. It's like, I actually compare this to somebody dying of cancer. You know, you've tried the regular cures, it hasn't worked, you've had a few remissions, but it's come back. And now you're into the quack faith cures. You know, you're bathing in milk, you're dousing yourself in this, you're going to faith healers who are sort of extracting things from your body. Leeches, maggots. We're sort of progressing down that step. So we've got to the economic equivalent of that.
Right, because the Fed at one point to accept as collateral for loans was taking old junk, rags, anything, and not just A-rated debt or AAA-rated debt. And it reminded me, it's interesting because roughly at approximately the same time when the BP oil spill in the Gulf of Oil, remember the junk shot? They were trying to stop the spill by stuffing old rags and golf balls into this thing. And here's the Fed, almost at the same time, saying, we'll take your old rags and golf balls.
Doesn't matter.
We'll give you $1 billion for that as collateral. So the entire system is breaking down. Now, there's a school of thought that with so much happening this is really kind of a massive tangent, but I'm going to go for it anyway. With so much happening on, economically speaking, in areas like social networking and technological networking and the open source movement, which is or crowdsourcing and crowdfunding. I don't want to put too many buzzwords into the same question. But there's so much
happening. You've done a good job so far. There are quite a few in there.
There's so much technology happening and innovation happening. Do you foresee a point where economics, which is itself evolving, and as Milton Friedman has proved, it's not a hard science because all of his policies have failed. You remember Jeffrey Sachs tried to reform Russia using Milton Friedman's policies, and he caused a lot of death and destruction.
He also tried to reform Chile. He tried to reform Bolivia. Most of it he's failed, but he keeps holding them up as successes, which is kind of interesting in itself.
Well, that's propaganda.
But you know what Galbraith said about Milton Friedman? He dismissed Milton Friedman by saying the problem with Milton is all of his policies have actually been tried. And I think you're absolutely correct. But come back a stage. I think, in fact, we are going to regress rather than progress in economics. We're going to go back to certain simple things. I'll give you a very good example of some of the movements in the world. In the United States, there is one state which is experimenting with a kind of funny money. It's actually not money. It's credits and debits of your time. So if you want to actually go and get something done, like get your hair done or something, you go to the guy, he gets his hair done, and you might be a lawyer. You say, okay, well, I owe you 15 minutes of my time. So if you have a problem, you want to sell a house, or you want to do something or get some advice, I do that. In fact, what we're seeing is almost a regression into a barter type of economy of a non-monetary stuff. Simply because I think people have realized, and this is what the gold price is telling us, that there is almost a total disillusionment with fiat money. There's a disillusionment with the system. I mean, if you actually look at the gold price, it's almost like a default position when people effectively go to when they hate everything else. And that's what it tells me. And so I don't necessarily see that we'll necessarily progress. The economists, particularly the academic economists, are holding up this flag. Oh, no, we have better models. We have better ways to do that. I'm not sure that's the way the world's going to do. I'll give you another example of that. Free trade. If you look at free trade, the Ricardian argument of comparative advantage is really the only basic premise of free trade at the end of the day, because we're all good at certain things. And there's the Heckler-Ohlin model, which is about factor endowments of different countries. Pretty much that's the only two models which have any meaning in trade. But then we find if we trade with each other, that's fine. But you've got to keep your exports and imports in line. If you don't keep them in line, we create these massive trade deficits and surpluses, which create the problem of the debt recirculation that China America problem, the Germany-Greece problem. So basically what we're finding is it's almost like going back to your grandmother's advice, or to even to Shakespeare, to Polonius, neither a borrower nor a lender be. So the world is almost regressing. So I think what out of this may come is something slightly different to a progression to new economics. It might be a regression to fundamental human relationships, because I think underlying economics and finance is trust. And I think this period of history is about a breakdown in trust. I'll give you an example of that. You see today in Greece, massive protests. Now, these are not professional anarchists. These are not professional hooligans. What we're seeing is a breakdown in certain social orders and social relationships. And so I don't see necessarily why economics would necessarily progress, but it might regress into more fundamental relationships, which we do understand and can manage.
Now, the raw commodity for financial engineering is interest rates or cost of debt, cost of money. And for 20 or 30 years, due to financial engineering, that cost of debt has collapsed and fueled its growth. But now
it's mispriced. It's basically been mispriced.
But now it's becoming more expensive as you have a credit seize up.
Absolutely. And basically, fundamentally, when you look at the amount of debt we have, and this is what is fascinating to watch about Europe, Europe misses a fundamental point. The Greeks aren't going to pay back the debt. The Portuguese aren't going to pay back the debt. Neither are the Irish. And maybe the Spanish and the Italians won't pay back all the debt. That means there's been a massive loss of wealth. Somebody has to pay for that. It has to come out of somebody's saving. By juggling the deck chairs on the Titanic, you're not going to actually avoid that. And when that wealth is wiped out, there's less money in the world. And therefore, A, the cost of that money goes up. And B, what you can do is severely limited. The wealth loss means people aren't going to spend. And nobody actually gets that at the end of the day, a credit crisis is about reducing the amount of wealth because you reduce the amount of debt that wealth funded. And that fundamentally reduces the world's capacity to grow. And so we're going to have to find different ways to grow. And that's the challenge to some extent that nobody wants to face up to, because they all want to play the paper shuffling games, because they're easier.
Right, the paper shuffling games are musical chairs of debt. We saw some amazing examples of that. I'm thinking back to the 2008 crisis. It was revealed that Lehman Brothers, through the Repo 105 scam,
lovely thing,
a shadow bank on Wall Street that they never disclosed in any of their regulatory filings, that when they were due to record their 10Q or 10K, their quarterly or annual numbers, they simply put billions of debt into this shadow bank that they never told anyone about, and then when the regulators left the office, they put it back on their balance sheet. So this is possible as long as the cost of debt is low, and it seems like all the policies like quantitative easing are an attempt to keep the price of debt low, but they're not working. Not working.
And I think fundamentally you've got to look at what, and to some extent I'm critical of Ben Bernanke, but I'm also sympathetic because he's been left with the load because the fiscal policy position in the United States is very restricted. He's cut interest rate. He's left with only quantitative easing to play around with. And fundamentally, if you actually look at what Ben Bernanke is doing with the printing money, he's trying to do two or three things. One, if you have low long-term rates, what it does is enable greater fiscal stimulus to be done. Because the lower the rate is, the bigger the debt burden the state can carry. It's very simple. That's what he's trying to do. The second thing he's trying to do is how do you get out of your problem if you're the US in terms of your debt burden? Well, you basically devalue the currency because roughly $3 to $4 trillion of your debt is held overseas. And so you devalue that to nothing. And remember, people talk about the $14.5 trillion. Roughly 6 is held internally by official bodies. So you're talking about 8. So you could actually wipe out of the 8 that's held, roughly half of that, by devaluing the currency. So Ben Bernanke, what he says and what he does have to be taken quite differently. He's just trying to devalue his way to solvency.
They would love to devalue the currency,
Absolutely.
But it's become a refuge for people getting out of these other currencies, like the euro.
It's a relative game. It's a race to the bottom. And the problem is all currencies are relative to other currencies. And you can't really have every currency can't be the cheapest. And this is the fundamental issue now, because the whole world's in this bind. If one person was in this bind, it's easy. You let him devalue. And I'll come back to that with Greece. Everybody thinks, me included, that Greece, Portugal, Ireland, maybe Spain and Italy shouldn't be in the euro. Because obviously it has two effects. One is they're uncompetitive, but what people forget is if it was a German-only euro, the euro would be at 2.20. But fundamentally, even if you devalue the Italians, the Greeks, and all those currencies by taking them outside the euro or doing some adjustment, that may not fix the problem. Because we have a world now without demand. Because you need external demand. And that's the US problem. Devaluing on its own is not going to work because you need external demand. And that demand just isn't there because it was debt-fueled. So it's like a catch-22. We keep going around and around and around. It's very difficult to break the cycle.
Okay, economics for a lot of people is, it's not their top subject. But I think most people can understand this concept of supply and demand.
Yep.
Right? And supply, if there's a big demand for something, price goes up.
Yep.
Now, there's two ways to approach an economic problem. You either look at the demand side or the supply side. In the case of David Cameron, what he just said over there in the UK was that he couldn't fix the problem by having people pay off their debt because this would cut into demand.
Correct.
But at the same time, because the economy is so ravaged by what's been going on there, the country itself does not produce anything, and there's no supply of stuff.
And that's also one of the ironies of this, because I look at Britain and the United States, the manufacturing base is gone, and to some extent you can rebuild it, but it's going to take 5 to 10 years to rebuild the base. And so fundamentally, devaluing the currency doesn't give you anything, because what are you going to sell to somebody else? And this is one of the fundamental arguments of trade, which I found to be inherently flawed, because we use China as a manufacturing base, which was fine. But the problem is you can't then do adjustments. If you want to adjust your export-import positions, you can't adjust it. And that means you're trapped. And there's another issue about this, which is actually quite interesting from a climatic change or environmental point of view. One of the things about, if you look at the consumption of certain fuels and so forth, it's driven by having long logistic supply chains. What's wrong with having a factory next to where the consumption is? It might be less efficient in terms of costs because you don't get the economies of scale and scope, but you do save on certain other things like fuel costs and so forth. And the other thing is, coming back to this issue of growth, a fundamental flaw in our thinking for the last 30, 40, maybe longer has been that growth is the answer to anything. What will bring people out of poverty? Growth. What will solve the problem of developing countries? Growth. Everything is growth. If we have too much debt, what do? We try to grow our way out of it. And Edward Abbey, the environmentalist, one observed that growth for growth's sake is the ideology of a cancer cell. And we have like a form of economic cancer, and it's very difficult to correct. And so we're going through these death throes of trying to change this growth culture to something else. The problem, of course, is everybody's hooked on increasing living standards, and growth provides that. And also there is what people call the emerging markets versus developed markets issue. Now there's two ways you can do that. If you keep growing the pie, you can give them more of the growth, and they can gradually catch up. But if you can't grow, then it becomes an appropriation issue. They're going to take away something. In my view, living standards in developed countries are going to fall very drastically because essentially they're going to be appropriated by the emerging markets who are less affected, by debt and some of the problems. But they're not unaffected, but they're less affected.
Right. Now, you were just mentioned there a second ago, environmental economics, or the effects of the environment in economics. And the phrase one uses in this case would be externalities.
Exactly.
So in the case of companies that are creating, let's say, an energy company, a big energy company, their cost of production and distribution and refining doesn't include the cost that they're incurring in the environment. It's an externalized cost. So, interestingly, though, in the technology business, it's a positive externality. The idea that when you have one fax machine, but if you had a second fax machine and a third fax machine, the externality here is that the value of the network increases.
Correct.
So the network externality increases in value. It's positive sum economics.
Absolutely, because everybody becomes more communicative in that sort of environment.
So, again, we're kind of returning to technology because you're really on the cutting edge with your book, Extreme Money. Of course, the fundamental raw material for the networks is the electron, and one could say that the cost per electron is genuinely virtually nothing.
Absolutely.
Versus, let's say, going back to the 80s, when they said that, well, nuclear energy would be so cheap we wouldn't have to meter it. But they didn't include the externalities.
Absolutely. And this is fundamentally one of the huge problems. And, in fact, Andrew Haldane, who's one of the deputy governors at the Bank of England, drew a wonderful comparison. He said the finance industry is exactly like the tobacco industry, which it doesn't actually factor in all the externalities. And what they did when they had this mindless period of growth with debt, they forgot to factor in the externalities. So, in fact, in economics, if you look at it, it's the valuation of externalities. This climate change debate is actually a fascinating one because people have got hooked on this debate between whether it's man-made, whether it's there. But the real issue to me is the externalities have never been properly priced.
So to wrap it up here, the externalities of these debt bubbles, the cost, no matter how much financial engineering and cleverness is applied, will not escape the being paid.
Absolutely not. And you look at this period of history, I mean, the interesting argument at the moment about bank regulations, for instance, is the banks are saying if you regulate us, we won't drive growth, which is fine. That's probably true. But the point is they don't ever factor in is that every time the debt bubbles or the bubbles that they create blow up, the cost of repairing that is just so great. So they take one part of the equation, the growth, but not the externalities. And fundamentally, if economics is to reform itself, if there is one area of economics which is important, is the area of understanding externalities, which interestingly enough has been with us. I mean, I remember I think the first papers on externalities were done around the early part of the 20th century. So it's not a new concept, but nobody ever does that. So coming back to your question of what economics will last, like you, I agree with Marshallian supply and demand curves will always last. Ricardian comparative advantage will probably last. And Pigot's work on externalities will probably always last and will be fundamental to the way we think. And I think that's the beauty of some ways of thinking. I think I accept that economics as a way of thinking is quite useful, but to then elaborate into a massive control system of how we control and run an economy is absurd, because we just don't understand those relationships, and the assumptions of things like rationality of how people behave is just equally absurd.
Now, of course, Thomas Malthus referred to economics as the dismal science.
Thomas Carlyle it was, actually.
Good enough, Thomas Carlyle. I mean, if you go back to the agricultural beginnings of humankind, 10, 12,000 years ago, you could say that economics kind of burst onto the scene there as a way to deal with the surplus.
Yes.
Suddenly there's a surplus, and now you need a way to how to figure this out.
In fact, you don't need economics and you don't need money if it's a subsistence economy.
Right, exactly. But, I mean, in a lot of ways, the Internet is becoming a subsistence clicking economy,
yep,
where people are clicking and receiving minimal sustenance from ad revenues, just enough to keep you alive and clicking. So, I mean, that's not necessarily a rosy scenario.
No, and I think that's basically about living standards contracting.
Right.
And basically, I think the whole issue about this global financial crisis, if you actually step back from it, is about the fact that living standards have been propelled by this steroid growth, which came from debt. And it was never going to be sustainable. Debt in small amounts was fine, but we just pushed the envelope. Human beings have an infinite capacity to take a good idea and make it bad by basically pushing the envelope to the limit. And that's what they did. And it's going to take us a long time to get out of it.
All right. Well, the book is Extreme Money. Just Google Extreme Money or Google DOS. This man is the rock star of economics.
Not bad for somebody who's not an economist.
Well, you dress like a rock star, all black, hanging out in Paris, smoking Gauloise.
Well, the only part of that I don't do is smoke Gauloise.
Satyajit Das, thanks so much for being on The Edge.
It's my pleasure.
All right, and that's going to do it for this edition of On the Edge with me, Max Keiser, and my guest, Das, who's the author of Extreme Money. If you want to send me an email, please do so at ontheedge@presstv.com. Until next time, this is Max Keiser saying bye, y'all.